Let's bring in Mike Tonkin, seeing that we bring you in, Mike, for a discussion of precisely things like the IMF and their growth forecasts. And really, I suppose the markets are about that growth forecast today. So it's markets looking at a bigger picture. Yeah. Overall, let's look at that assessment. It seemed to me, just scanning it, that the UK is the only one where they've revised upwards. And their number there was 0.3 before growth, and now they're looking at 0.9 growth.
Yeah, I think you need to look at it. I mean, there are really big structural changes happening globally, and where there are big structural changes like that, there are bound to be frictions, and ultimately winners and ultimately losers. And if you look at the US, what's happening there with potential tapering, the pulling back of liquidity, what's happening in China, like we just spoke about now, and even what's happening in Japan with the Bank of Japan with their sort of monetary experiment. Unfortunately, the losers in this particular period seem to be the emerging market economies.
Let's just look at the South African, and just to come back to that point made earlier, we always seem to be optimistic for next year and even more optimistic for the year after. Year. And it's the one area where I don't trust the Reserve Bank and the Treasury, because they're almost bound to take the most positive view possible.
Yeah. I suppose they have to. I mean, at the end of the day, they can't represent a gloomy picture, I suppose. But I suppose their credibility is on the line. They've got to present a realistic picture. Now, unfortunately, other than China's growth resurging, I don't know what's going to ever take us, well, not ever, it's a long time, but what's going to take us in the next 5 or 10 years to above 3%, let alone 4 or 5%. I just don't see the impetus. I mean, the resource cycle may recover, probably will recover, but that's the only real growth engine we've got, and it's external, it's not internal.
Can you answer that question, Mike? What will take us out?
If you look at the countries that benefited massively from the last few years from this sort of free flow of money coming out of the States on the back of low interest rates, South Africa was one of the countries that benefited the most. And unfortunately, in an environment like this, where you see the potential for that liquidity to start pulling back, it is absolutely going to be those exact same countries who suffer the most. And we cannot depend on the commodity cycle to bring us out of this sort of situation anytime soon. So you've got to start looking at more internal factors. Are we going to become more productive? Is the labour force going to become more productive? Never mind wages, etc. And then other issues like electricity supply and all those sort of things come into it.
But you're talking about South Africa now.
Correct. But you look at growth there, and unfortunately, you cannot look externally anymore. The world is changing. We need to start looking, I think, more internally and how we can do things better to become more competitive in the global market.
Look, I mean, I understand, of course, China has been the driver for the resource sector for quite some time. There is still the story of Africa. Unfortunately, the African story is also to a certain extent dependent on the Chinese story. I mean, many countries have seen, huge GDP increases primarily driven by commodity price increases. But that being said, we still have, a whole continent up there, hundreds of millions of people growing at 6.5% a year. And there should be some ability for us to actually take advantage of that to a certain extent. Unfortunately, the kind of moves that we've seen in our economy at the moment, the problems with Eskom pushing back towards Dubai till the end of next year. Also seeing problems with regards to corruption, in terms of growth, etc., affecting us. I don't know whether or not we will be able to take advantage of the opportunity that Africa is going to present. I mean, we're a tiny country, we're 50 million people on a continent that's, many multiples the size of us, and it's growing incredibly fast as well. Yes, it's from a low base, but I mean, you grow long enough at this kind of rate, the low base is no longer there.
Well, it's interesting on the list that they put out. I mean, there it is, South Africa, 2.5 was the estimate in April 2012, now down to 2. It's one of those, I mean, that's what my arithmetic, a 20% drop. And if it goes below 2, then psychologically it starts looking very bad indeed. It starts looking like those European countries. And above it on the list is Africa, revised from 4.9 to 5.1. So the gap between South Africa and Africa as a continent.
We are positioned very well, obviously, to benefit from African growth, but this is still a long story. I mean, African growth is not going to take our economy to 5% in the next 2 years. This is one of these long cycles. We might benefit quite dramatically over a 10-year, over a 15-year basis. But in the shorter term, I just don't know what the answer is. We can't solve our power issue in the short term. We can't solve our education. We can't solve labor disputes and productivity. You just can't solve these things in the shorter term. And it all boils down to one single thing. I don't think we're competitive for a multitude of reasons.
Mike, you're nodding at that.
Yeah, and just on what Wern was saying about that gap narrowing between the growth rates, where we are now, if you look at the developed market growth rates compared to emerging market growth rates, that gap is the narrowest it's been in some time. So that's really an indication that the big developed economies of the world are starting to do better. And we are seeing that in the States. It's coming through in the employment figures, the job creation, consumer confidence, all those sort of things. It's the reason the Fed is tapering. I mean, the economies are doing better, but unfortunately, as I said at the beginning, these emerging market economies are going to continue to battle for some time, I think.
But it's also emerging markets and it's big markets, not just emerging. You sent me an article earlier today, what's good for the US, China, Japan hurts emerging markets. Now, you could say that China's an emerging market, but it's a big player.
Yeah, absolutely, and we've sort of touched on it a bit earlier. And there was a bit of a scare a couple of weeks ago about the sort of credit tightening happening in China.
The squeeze, as they
the
call
squeeze there, and it's got a lot to do with that shadow banking system. They experienced massive expansion, 9% growth rates for quite some time on the back of very expansionary monetary policy, massive government spending, obviously using as much and as many resources as they can, driving exports from countries like Australia and South Africa, but it is very, it's very definitely slowing down, and that is having an effect across the board.
Viv, let's come back to your point that you made a bit earlier about us being competitive. Well, the point generally made about us being competitive. Eskom is one issue. Now, you can't build a power station faster than you can build it, and they've now put it back, so that's kind of intractable. But something that could change is an attitude to labour, to productivity, to negotiations. We're going into the gold mining negotiations now. But the way we're thinking about that, we've kind of taken for granted that there's not going to be an improvement. Although a change of attitude could produce an improvement. The point's been made with our gold mining, in fact our mining industry generally. Other countries work 24/7. The shifts are 24/7. We've got these archaic arrangements whereby we work, take breaks in our production. But it's as if that is impossible to change.
And also, I mean, look here, the problem with South Africa's mining sector is that we have just a huge number of miners working in the mines in conditions that we have to admit are not, ideal and not comparable. I mean, in fact, they would be illegal in most of the parts of the developed world, However, the fact of the matter is our miners cannot be as productive as the Australian miners or miners elsewhere in the world that are getting the better salaries, etc., because the skilled levels required is not going to be there.
And much more mechanization.
And look, the gold mining sector, I think that I saw a report recently from Citi that apparently at the current price level, the average price of gold, so the average cost of production of gold is above the current price level of gold. So think about it that way. You can't have a market in which the average cost of production is above the price at the moment, I mean,
the horror could be, Wayne, that by the time the recovery comes, our whole industry has disappeared. Like the gold mining industry.
Look, the gold mining industry is, the cost issue is primarily related to the ore grade. There's just not enough profitable gold around. It's not as though 2 years ago you were swimming in profitable gold. Now because your costs have escalated, it's actually an ore issue. Obviously it's a cost per ton of ore taken out the ground, and then the yield from that ore, it's just been declining for maybe 15 years now. So, I mean, the gold industry, it's a tough thing to say, but the gold industry won't be around in 15 years because the gold's finished.
It's finished.
So it's finished. You can't profitably mine the gold on a sustainable basis. Probably even if the price had to go to 1,600 or 1,800 per ounce, in 5 or 6 years' time, there's just no more gold that you can mine profitably from that. But the problem is, where's the growth industry in South Africa? Platinum will come back, but that's also a long cycle.
We hoped it would be tourism.
Yeah.
It seems like a very frail thing to come to the rescue, doesn't it, Mike?
Yeah, it does, and then you start looking towards things like services and manufacturing. It comes back down to, the point about us being competitive and even being named as one of the BRICS countries. Unfortunately, the population our size and a labour force that is not particularly productive, and not just in the mining sector, with high wages, across the board, it's very difficult to be particularly competitive on the global scale.
There was a hope that we would become to BRICS what London is to financial, the financial world. And with the one thing we can claim is a good banking sector, a good financial services sector in the top couple in the world. But it's not enough to go on, is it?
No, I think our inclusion in BRICS, we got to admit, was basically a PR move by China. I just wanted to have to say, okay, look, we have an African country in here, and it was basically between us, maybe Kenya or Nigeria, and they just started to go with Africa for whatever reason, because maybe we're the most advanced, etc. But I mean, if you look at it, no, from an objective point of view, in 2 years' time, I don't see how we would be the #1 country in terms of GDP in the continent. Will probably be Nigeria by then, and with the growth rates that's going forward, I mean, in 10 years' time, there's no ways that we would say South Africa will be the leading country, except maybe in terms of, like you said, you know, an advancement in certain sectors, but in terms of the total economy, I would assume by then Nigeria would have left us in the dust.
Mike, just to finish off, Ben Bernanke's doing a talk tomorrow. His words will be watched very closely. The minutes of one of the Fed meetings is coming out, so you'll be looking at that.
Absolutely, and the market always looks towards the exact words and they inspect them. You know,
in fact, too much so.
Yeah.
Almost overanalyze them. But the reality is the entire global markets and the changes in the global markets currently are simply due to what the Fed is going to be doing potentially as early as September. And you know, so we're all going to be watching very closely. It's having ripple effects to a certain extent across the pond in Europe as well. But you know, again, the market likes certainty. It's this uncertainty that they don't know. So even though tapering is negative, as long as there's a fixed date and the market can prepare and act accordingly, I think that's what investors